Earnings growth will be picking up this quarter and next, which should help drive stocks higher. That's according to LPL Financial Research, which has published its mid-year outlook. I'm joined by John Cannally, economist and strategist with LPL. Nice to see you again, John.
Good to be here.
I know there are a couple of themes you're watching for the rest of this year. One is a potential turnaround in a few markets. What are your expectations?
Yeah, so we still see modest single-digit growth in the U.S. equity markets between now and year end, but you're going to get some volatility between now and then. So we expect the market to end maybe a couple percentage points higher on a total return basis, but wouldn't be surprised if at one point we're up 10% on the year, or if at a different point between now and the end of the year that we're down 5 or 10%, because this tends to happen in an election year, especially the second half of an election year, is that you get some volatility. So not modest gains, but a lot of volatility, certainly.
In terms of that volatility, will it be just driven by what's happening in the U.S. in terms of elections, or potentially more overseas turmoil post-Brexit?
I think it's all of the above. I don't think we fully felt the impact of Brexit yet. We're starting to hear from companies reporting their second quarter earnings this week. We'll hear a lot more in the next couple of weeks. So far, the Brexit mentions in these earnings reports have been muted, but you'd expect over the course of the next couple of weeks and months that you'll hear more from there. And of course, as we discovered over the weekend, geopolitical risk can happen at anywhere, at any time, even on a summer Friday in a place like Turkey. So that's still out there. And the election, of course, is sort of on a simmer mode now, I'd say. The Republican convention this week, Democratic convention in a couple of weeks. Markets won't really start to pay attention until September or so. So there's a lot of catalysts out there for that potential volatility.
One thing you do see that's a positive is increased investment by U.S. corporations. So how will that help drive earnings? And is that essentially a vote of confidence?
Yeah, that's kind of what we're looking for, a vote of confidence from corporate America reinvesting in the country. They've done a little bit of hiring. They've paid down some debt. Now, what you like to see them do is invest a little bit more, do some capital spending. We're still in a pretty good spot capital spending-wise. The U.S. has a pretty big advantage in what we like to call good old American know-how. In other words, we're the world leader in intellectual property. We do a great job exporting on the service side. We've been a little slow in this recovery doing good old-fashioned capital spending. We've seen some in transportation, but you like to see that spread beyond just transportation. And companies certainly have the wherewithal to do that. All that's missing is confidence, really.
And John, what's your outlook for the Fed and economy for the rest of the year?
Sure. The Federal Reserve is kind of stuck between a rock and a hard place. They've signaled that this year, at the start of the year, they thought they were going to do 4 rate hikes. In March, they took that down to 2. And in recent commentary, they've kind of taken that down to 1. The market right now expects no hikes this year, perhaps 1. So the market and the Fed are fairly well in balance. The wild card there, though, could be inflation. So even if oil stays where it is right now, which is around $50, by the end of the year, CPI inflation could be well up over 2%, approaching 3%. That could pose a problem for the Fed. Also, job creation may pose a problem for the Fed. Job creation is likely to slow over the remainder of the year. But even if it slows down to 120 or 150,000 jobs per month, that's enough, according to the Fed, to tighten the labor market, push up wages, and push up inflation. But for the overall economy, we still see modest growth, 2 to 2.5% growth, just above the economy's long-term potential, and that too will tighten resources and push up wages and likely push up inflation as well.
John Cannally with LPL Financial. Thanks so much for your insight, John.
Thanks, Rhonda.
I'm Rhonda Schaffler for The Street.